Hello and welcome to a new video. Today we'll be discussing the recent interest rate cut in the US and its implications for the financial markets. By looking back at past events, we can see clear parallels to earlier crises and recessions. I'll explain why the yield curve is a reliable indicator of upcoming downturns and why this may be the best time to build cash reserves. We'll also cover how long it typically takes for markets to bottom out and which sectors and companies are likely to lead the recovery. Let's get started. Why the recent U.S. interest rate cut is so important. The recent interest rate cut by the U.S. Federal Reserve has surprised many market participants and raised numerous questions. Interest rate cuts are one of the most powerful tools of monetary policy, with far-reaching effects on the economy and financial markets. In this video, we will explore why this interest rate cut is so significant, examine historical parallels, and discuss how investors can position themselves during such volatile times. We will take a closer look at bond market trends, labor market reactions, and the impact on companies and their access to financing. The importance of the yield curve, a recession early warning system. Let's start with one of the most important early indicators of economic downturns, the yield curve. What exactly does it mean? The yield curve shows the relationship between short-term and long-term bond yields. Normally, long-term bond yields are higher than short-term ones because investors expect a higher return for the uncertainty associated with longer-term investments. However, when this relationship inverts, meaning short-term bonds yield more than long-term ones, it signals a so-called inverted yield curve. This is a strong warning sign of an impending recession. Let's consider two historical examples. Between 1999 and 2000, we saw an inversion of the yield curve just before the dot-com bubble burst and the subsequent economic downturn. A similar pattern emerged before the global financial crisis of 2007 to 2009. The current situation bears many similarities. The yield spread between 2-year and 10-year Treasury bonds had turned positive just before the recent rate cut, indicating uncertainty in the markets and a potential economic slowdown on the horizon. Why the yield curve is so reliable. The reason the inverted yield curve is such a reliable indicator is that it reflects investors' expectations about future economic developments. When short-term rates are higher than long-term ones, it signals that the markets expect the economy to weaken in the near future and that central banks will respond by cutting rates. This becomes a kind of self-fulfilling prophecy. If enough market participants believe the economy is going to slow down, they take actions that make this scenario more likely. The connection between interest rates and unemployment. Another key indicator often associated with interest rate cuts is the unemployment rate. In recessions, unemployment tends to rise as companies cut costs and lay off workers. This creates a negative feedback loop. When more people are unemployed, demand for goods and services drops, which further slows economic activity and forces companies to cut even more jobs. During the 2000 to 2003 recession, which followed the dot-com crash, the unemployment rate in the U.S. rose from around 4% to over 6%. A similar pattern occurred during the 2007 to 2009 global financial crisis, when the U.S. unemployment rate climbed above 10%. An increasing trend in unemployment is a clear signal that the economy is weakening and that companies are struggling with financing. The impact on corporate financing. Why liquidity is critical. One of the biggest challenges for businesses during a recession is accessing capital. When interest rates are high, borrowing becomes more expensive. Companies, particularly those with high levels of debt, face rising interest payments, which squeeze their profit margins. In such times, it becomes difficult for firms to fund new projects or service their debt. This situation is especially challenging for companies in cyclical industries, such as construction, automotive, or industrial production. These sectors are highly dependent on economic activity, and when demand falls, they face significant financial difficulties. In contrast, companies in defensive sectors such as healthcare, consumer staples, and utilities tend to be more resilient to recessions as demand for their products and services remains relatively stable. The delayed impact of interest rate cuts on markets. Many people expect an interest rate cut to lead to an immediate recovery in stock markets, but that's often not the case. After the first rate cut in a high-interest environment, like the one we're in now, markets usually take some time to react. Historically, it has taken several months for markets to reach their bottom after an interest rate cut. A good example of this is the period following the rate cut in 2007. The Fed started cutting rates in September 2007, but the markets didn't reach their bottom until March 2009, almost a year and a half later. During this time, major indices like the S&P 500 and the Dow Jones fell by more than 50%. A similar pattern occurred after the first rate cut in 2000. The Nasdaq 100, which was dominated by tech companies at the time, initially fell further and lost more than 70% of its value within 2 years. This delayed reaction shows that rate cuts don't create immediate miracles. It takes time for the effects of lower rates to trickle through the economy and for markets to regain confidence. Cash is king, the best strategy during crisis periods. What does this mean for investors? In times of economic uncertainty and after the first rate cut in a high-interest environment, it's crucial to build liquidity, or cash. Cash not only provides safety in turbulent times, but also allows investors to seize opportunities when the markets hit their lowest point. It's important to understand that the best investment opportunities often arise when markets have fallen the most, during the so-called capitulation phase. This is the moment when many investors lose hope and give up their positions. Historically, this often marks the bottom of the market and offers long-term investors the chance to buy quality stocks at attractive prices. What companies should you invest in? One of the best investment strategies during a recession is to focus on companies that have already proven themselves to be stable and successful. Particularly attractive are dividend aristocrats or dividend kings. These terms refer to companies that have consistently increased their dividends over decades and have robust business models. Some well-known examples include companies like Johnson & Johnson, Procter & Gamble, or Coca-Cola. These firms are typically less vulnerable to economic downturns because their products and services remain in demand, even during tough times. Furthermore, it's advisable to include companies with low debt and stable cash flows in your portfolio. In economic downturns, highly leveraged companies suffer more as they struggle to service their debts when revenues decline. On the other hand, companies with strong balance sheets and low debt levels have more flexibility during crises and can even gain market share from weaker competitors. Historical losses and future opportunities, what we can learn from the past. Looking back at history, we see that stock markets often suffer significant losses during recessions. During the global financial crisis of 2007 to 2009, the S&P 500 fell by more than 50%. Similar declines occurred during the dot-com bubble from 2000 to 2002. Such losses can be discouraging, especially for short-term investors. However, for long-term investors, these declines offer the best opportunities. After a significant market drop, some of the strongest recoveries often follow. Historically, investors who bought at the market's low points have achieved above-average returns in the following years. For example, in the 3 years following the 2009 market low, the S&P 500 delivered an average annual return of over 20%. How can you identify the market bottom? One of the biggest questions for investors is how to recognize when the market has hit bottom. Unfortunately, there is no precise moment that can be accurately predicted, but there are several indicators that can help identify the right time. One of these indicators is the stabilization of interest rates. Once the central bank has cut rates and kept them at a low level for a while, this often signals that the economy is stabilizing. Another important indicator is the unemployment rate. When it reaches its peak and begins to decline, this can be a sign that the economy has passed its lowest point and is starting to recover. Which sectors benefit the most from a recovery? After a recession, certain sectors traditionally benefit first from an economic recovery. These often include cyclical industries, such as consumer goods, technology, and industrial production. These sectors are highly sensitive to economic changes and benefit from the recovery of economic activity. In the second phase of the recovery, known as the accompaniment phase, when the economy stabilizes, defensive sectors such as healthcare, consumer staples, and utilities tend to provide stable returns. These sectors are characterized by steady cash flows and less reliance on overall economic conditions. Conclusion: patience and strategic planning are crucial. Interest rate cuts and economic downturns can be unsettling for many investors, but they also offer immense opportunities for those who approach the situation strategically and with patience. The key advice is to build liquidity, invest in solid companies with strong balance sheets, and avoid panic when markets fall further in the short term. Those who are able to invest during difficult times can benefit from above-average returns in the long run. During these phases, investors should focus on quality companies with a long history of stability and dividend continuity to make their portfolios more crisis-proof and be prepared for the upcoming recovery. Thanks for watching this video. I hope you gained some valuable insights on how to position yourself during economic uncertainty and take advantage of the opportunities markets offer after a recession. Remember, patience and a sound strategy are key to long-term investing success. If you enjoyed the video, please give it a thumbs up and subscribe to the channel so you don't miss future updates. Drop a comment below sharing your thoughts on the current market situation and how you're preparing for it. See you in the next one.